Have you ever wondered if you should change your investment risk profile during retirement? Hi, my name is Josh Palmer, Director of Financial Planning for the Noble Group. There are a lot of caveats to investment risk. Do we want to take more risk with the possibility of more return, but with also a possibility of more loss? Or do we want to minimize our risk with the ability to maybe minimize our loss, but not get so much on the upside? One of the 4 variables that we look at in financial planning is allocation of assets. Are you correctly allocated from your asset side to take advantage of your risk profile? What we don't want to see is we don't want to see you taking more risk than you can really stomach. On the other side, are you so adverse to risk that you're not going to be able to meet your goals, which at a minimum needs to be outpacing inflation? The best thing to do to look at where investment risk plays in your overall planning portfolio is to look at a plan. In this situation, we have a client age 60, about $1 million in assets. They want $8,500 a month in income, today's dollars after taxes, and we're going to look at a Medicare goal so that we know that at retirement, we have Medicare coming out of Social Security. Now, in this situation, they're a balanced portfolio, taking a little bit of risk, but is that right for their plan? What we have here in this situation is a client that looks like they're in a good spot. You can see by this probability of success meter that they're about 85% probable of meeting their financial goals. What this means is that 850 out of 1,000 trials are successful. Successful trial means that there is money left over at life expectancy. That's good because we don't know when life expectancy happens. We can take a best guess, but if you live a day, a year, or 10 years past that life expectancy, we need to make sure that there's a bucket of money to help continue your long-term financial goals. Now, in this case, you can see that $8,600 a month with the healthcare goal, they're sitting right where they need to be. They're in the middle of our green zone. That's our confidence zone. Anything below that in our purple zone is below confidence. It means that we're not comfortable with enough of the trials that make sense, that make us feel that your plan is going to be successful. Conversely, if we're above the confidence zone, we're not spending enough of our money, meaning at your life expectancy, you're going to have a big bucket of money that your beneficiaries are going to have a heyday with. What we want to do is avoid that and make sure that you're spending the amount of money that you want to spend for the work that you put into it. Now, in this situation, we look good. The question is, what do we do with our risk profile during retirement? We actually have an analysis that we run that's going to show what happens if we take a balanced portfolio and we take more risk or less risk during retirement. What we're looking at here is a balance with growth before retirement. That's where the client is. That's what they're comfortable with. The question is, once they retire, do we scale that risk back, or do we need to take more risk to help us meet our financial goals? In this analysis, you can see that before portfolio, we're balanced with growth. After, do we want to dial it all back? A lot of clients, when they retire, think, I'm not working anymore. I need to take all the risk off the table. Let's go as conservative as possible. Some clients think, you know what? I'm not working anymore. I don't have any more savings going in. We need to be on the other end of the spectrum and take more risk to make sure that we're going to make that long-term plan work. You can see in this chart, and I think it's pretty interesting how the chart is kind of like a upside down U. If we take less risk, we can actually see that our probability of success drops. Why? That's because we're not taking enough risk, we're not getting enough return, and that over time, inflation is eating into our portfolio at a quicker rate. Now you can see that going to a conservative portfolio during retirement is still within confidence zone, and that's good. The problem is we're getting closer and closer to that below or that purple zone where we would have to make further adjustments. You can see that if we look at this growth portfolio, it actually brings our confidence level down. The reason being here is that we're taking too much risk. We're getting rewarded, but we're not getting rewarded enough for the downside that we're having to take. So our probability of success drops. Now, you may be thinking, all right, we're still in 83%. We're still in the green zone. The problem is the roller coaster just got a lot more bumpy. Are you willing during retirement to have the years where you lose a lot, thinking that you're going to have time to grow it back? Most people aren't comfortable in that level. On the flip side, if we're too conservative, during retirement, you're not making as much as you think you should be making, and your withdrawals are outpacing your investments. The best thing in this situation, the highest level of confidence would be maybe we can take it back a notch or two. And that's usually the recommendation we make. At retirement, let's scale back our risk, not 3 or 4 levels, but maybe 1 or 2. Maybe make it where it's a little more of a slow and steady ride than having all the ups and downs. Because the thing is, during retirement, you don't have as much time, you don't have the dollar cost averaging or the consistent investment over time to offset those losses. There's a lot of different situations when it comes to what should I do with my risk profile during retirement that are going to be dependent upon your situation, your goals, your assets, your savings, your cash flow. If you have any other questions on this, please give us a call or go to our website at thenoblegroup.com, or you can send an email to education@thenoblegroup.com.